It is currently Sunday, November 30th, 2025. The markets are closed, and the silence is deafening after what can only be described as a historic, perhaps even catastrophic, explosion of volatility. If you are looking at your screen right now, checking the last traded price for SMX, Security Matters Public Limited Company, you are staring at a figure that defies almost every logical gravity model used in traditional finance. The stock closed on Friday, November 28, at exactly $61.04. This is not a typo. This is not a glitch in your Fidelity mobile app or a data error on your Interactive Brokers trading terminal. That represents a single-day gain of approximately 250.80%. But to simply say it is up is to insult the magnitude of the move. Just days ago, earlier in the week, this equity was languishing in the single digits, trading near $5.90. We have witnessed a move exceeding 1,000% in a shortened holiday week, a parabolic vertical ascent that has likely liquidated short sellers, minted accidental fortunes for risk-tolerant retail traders, and left the vast majority of the analytical community absolutely speechless. This is the definition of a market anomaly. And whether you hold Tesla stock, Apple stock, or are just watching from the sidelines with a Schwab Intelligent Portfolios account, you need to understand the mechanics of what just happened with SMX because it exposes the raw, exposed wiring of the modern stock market. The expectation for a company like SMX, a microcap stock with a history of devastating dilution, multiple reverse splits, and a chart that looks like a staircase into the abyss, is that it is dead money. The expectation is that this is a stay-away zone, a place where Fidelity Wealth Management advisors would never let a client tread, and where Schwab Intelligent Portfolios would algorithmically blacklist the ticker. The narrative has long been that SMX is a cash-burning science experiment with no commercial viability, destined to be delisted and forgotten. That is the expectation. The reality, however, has violently diverged from that script. The reality is that SMX has effectively engineered a perfect storm of technical float constriction and a sudden fundamental narrative shift regarding global supply chain verification. While the market was distracted by the usual tech giants or the latest AI surge in NVIDIA stock, SMX was quietly executing a 1-for-8 reverse stock split effective November 18, 2025, which reduced its tradable share count, the float, to microscopic levels. When you combine a float that is estimated to be under 1 million shares with a sudden injection of high-velocity news regarding partnerships and a refinery reset, you do not get a rally. You get a liquidity vacuum where the price must teleport higher to find sellers. This is no longer just a stock, it is a scarce digital token representing a claim on a very specific and suddenly very hot intellectual property. Let's dismantle the technical setup first, because without understanding the plumbing, the price of $61.04 makes no sense. Most people accessing the markets through Robinhood stock trading or SoFi Invest are accustomed to liquidity. You buy, you sell, and the spread is a penny. But when a company executes a reverse split like SMX just did, consolidating shares to regain NASDAQ compliance, they artificially choke the supply. The 1-for-8 split meant that for every 8 shares that existed, only 1 remained. This creates a scenario where any surge in buying pressure, whether from retail traders organizing on social media or institutional algorithms detecting a breakout, forces the price up vertically because there are simply no shares available to buy. It is the financial equivalent of trying to push a swimming pool's worth of water through a garden hose. On Friday, amidst a shortened trading session and reports of a data center glitch affecting CME futures, SMX became the idiosyncratic play of the day. volume surged to over 22 million shares. Think about that math. The float is likely roughly 1 million shares, yet the stock turned over its entire available supply 20 times over in a single half-day session. This indicates high-frequency trading bot wars, massive churning, and a complete detachment from fundamental valuation in the short term. It is a pure supply-demand dislocation that would make even the most seasoned Interactive Brokers trading veteran sweat. But to dismiss this purely as a pump misses the second, more fascinating half of the reality equation, the fundamental reset SMX is pitching to the world. While the price action is technical, the catalyst is structural. On November 28, simultaneous with this price explosion, the financial newswires were flooded with a very specific narrative: the Refinery Reset. The company is positioning its technology not just as a tracking tool, but as a molecular firewall for global trade. The core proposition is that in a world of rampant counterfeiting, greenwashing, and supply chain fraud, digital records are insufficient. You can fake a barcode. You can fake a blockchain entry if the input data is a lie. You cannot, theoretically, fake a molecular marker embedded into the chemical structure of gold, steel, or plastic. This is the reality that is suddenly exceeding expectations. Investors are waking up to the idea that SMX might not be selling a product, but rather a new global standard for truth in materials. The news flow highlighted that in 2025, SMX didn't just chase partnerships chased them. The claim is that 6 major agreements have created a network effect, culminating in a presentation at the DMCC Precious Metals Conference in Dubai that allegedly reframed the global narrative around gold transparency. This is where the story gets heavy. If you are sitting there with your Fidelity brokerage account looking at this 1,000% gain, you have to ask yourself, is this the market pricing in a monopoly on truth? The company's recent PR blitz argues that they are turning proof into a currency. They are claiming to solve the shadow zones of the bullion trade. By embedding a marker into gold that survives melting and recycling, they effectively destroy the black market for conflict minerals, or at least that's the pitch. If SMX technology becomes the regulatory requirement for entering the Dubai or European markets, the company changes from a penny stock into an infrastructure utility. This is the blue sky scenario that is currently battling with the gravity scenario. The tension here is palpable. On one hand, you have a company that has incinerated value for years, requiring almost constant capital raises and reverse splits just to keep the lights on. On the other hand, you have a technology that claims to be the DNS layer of physical matter. The market is violently trying to reconcile these two truths. Is SMX a zero, or is it the NVIDIA stock of supply chain integrity? The sheer velocity of the move on Friday, closing at the high of the day, suggests that the market is currently voting for the latter, or at least short sellers are too terrified to vote for the former. Short interest in SMX has historically been high, and with the new lower float, the cost to borrow shares for shorting on platforms like Interactive Brokers has likely skyrocketed to triple or quadruple digits. This creates a short squeeze loop. Bears who expected the stock to fade back to $5 are forced to cover at $20, $40, and $60, their buying pressure acting as rocket fuel for the rally. It is a brutal, mechanical grinder. If you are a retail investor using the Robinhood app or SoFi Active Investing, you must understand that you are entering a battlefield where the laws of physics are temporarily suspended. The price is not moving because of earnings per share, it is moving because of a liquidity crisis. We must also discuss the role of the broader market environment in this move. It is 2025. The appetite for deep tech and hard tech has returned. Software is seen as saturated. The real money is now chasing physical digital bridges. This is why you see money flowing out of generic Fidelity ETFs and into specific, high-risk, single-name equities that promise to solve physical problems. SMX fits this zeitgeist perfectly. It is not an app. It is chemistry. It is physics. It is hard to replicate. This moat is what the bulls are clinging to. They argue that the financials are ugly, but the IP portfolio is priceless. This is a classic venture capital thesis playing out in the public markets. You are paying for the option on the technology becoming a standard. If Schwab Intelligent Portfolios are designed to minimize risk, SMX is designed to maximize variance. It is a binary bet. It either goes to zero or it goes to hundreds of dollars if adoption hits critical